Hello property entrepreneurs. Tonight we are talking about how to scale your property business, and we're doing it at the Baker Street Property Meet with 150 passionate property entrepreneurs. Yeah. Our next talk is from Paul Oberscneider. Paul Oberscneider has scaled a business from nothing, created a multi-million-pound business, property business, European-wide. He's author of the best-selling business book, How to Sell Tacos to Africa. He started off life at Wall Street, and today he's at Baker Street. Nice to meet you. So what Paul's going to be sharing with us tonight is really from a funder's perspective, because if you're going to scale your property business, it's all about getting funding. That's the fuel to growth. Paul has raised both debt and equity finance during his property career, and is now in the position where he facilitates lending that out to other property entrepreneurs. And he's going to share some top tips for how you can present your case to a lender. So without much further ado, please give a big, warm Baker Street welcome to Paul Oberscneider.
It's like speed dating. I've got 15 minutes to preach the gospel. So I'm Paul Oberscneider. My career started in Chicago Board of Trade. I was 19 years old. It was lots of fun. Most of you don't remember those days. I'm dating myself basically because this doesn't exist anymore. But in 1987, I left. Well, no, 1982, I left Wall Street and started my property career. But I went off to Europe, which was going to be a holiday, basically, and I never came home. I landed in Tallinn, Estonia, a country that I didn't know very much about. I didn't speak the language, and over the course of the next 18, 20 years, we built probably the largest fully integrated property company in Central and Eastern Europe with 650 people. We had 35 offices across 5-6 different countries. My partners were institutional investors like Apollo, Citigroup, Heitman, Granger, and I built over 3 million square feet of commercial retail development, 5 luxury hotels, and in 2007, we were in Warsaw building 22,000 flats. So I'm a developer. I'm one of you guys, but I actually started by building one flat at a time. You know, I built it for myself because I needed a place to live. I never moved in. I rented it to the embassy. I said, that was easy. I'll do that again. I built another one, did the same thing, never moved in. I never moved into any of these things. And that led to building a business which became quite a large, fully integrated, with lots of verticals, property business. I'm going to throw up a slide here quickly because I think we all need to understand where we are in the market. You know, given the cycle, you need to be smarter. And we're going to talk about how when you're approaching funders, you know, you need to be prepared. But, you know, let's look back here. When I started my career, the Dow Jones was 750. Interest rates were 18%. Yeah? And I lived through the salad days of watching the market get pushed by the liquidity wave that Alan Greenspan provided the world, basically. And that liquidity wave made, no matter what asset class you were in, really easy to make money in. I mean, you really had to kind of be a bit daft not to have, you know, to have benefited from that. So today, here we are, the Dow Jones 25,000, and interest rates, well, you know, where it depends where you are, but here they're, you know, what is it? What's the Bank of England base rate? Yeah. where do we go from here? All I can tell you is we're not back here. And I can't predict the future, but at the cycle that we're at, I'd say things are shifting. I mean, GDV values have fallen by 25, 30% in a lot of markets that you're working in. Sales periods have extended by 18 months, 18% or more. The market's changing. It's not the salad days anymore. So as a property developer, when you go and try to find funding, you need to think about what it is you're going to be giving to funders in order for them to make the best decisions for you. I've put up kind of 4 common funding pitfalls that I see on a regular basis that developers not face but have to encounter. One is I don't see a lot of credible deal memos, and we'll get to that in a moment. The other thing is I don't think a lot of people really, and it was talked about by Rob and by Romy as well, they're not underwriting the professional team. Then you've got to go out and piece together the senior, the mezz, and the equity separately. That takes time. It takes a certain skill set, and most of property developers don't have that. And the other thing that a lot of guys think of is they think of price. They think of interest rate. Oh, that's really expensive. That's not going to work for me. But it's really not the interest rate. It's how the deal is structured, right? It's the interest rate is a marginal cost. Today, I really want to focus on one of those things. I can't go into all 4 entirely, but so I'm going to talk about a credible deal memo. So when I was working for Apollo, or had Apollo as my operating partner, they're a big institution, and I got institutionalized. So, when I put up, when we approached a deal, we had to produce this massive paper with all kinds of information for our funders. And it looked like that, basically. This is actually a real deal. 35 pages long deal memo. How many here put together a 35-page deal memo? Very few. What's in a deal memo? Well, you've got your project overview, you've got a preliminary market overview, you've got to describe your project location, you've got to understand your unit stack, you've got to have the right financial valuation, you need to put your exit strategies together, you've got your modeling, you've got your project team CVs, you've got to think about what the key risks and mitigants are, and you throw that all together and you get one of these. Now, when we see deals come across the table these days, and we provide, so Hilltop Credit Partners is a hybrid capital provider. We're not really a lender, we're more of a partner. We're providing 75%, we're capped at 75% of LTGDV, and we provide 90% of cost. But our returns are fundamentally driven by the end of the project, by the successful completion of that project. So we're quite aligned with the developer. We're not so much interested in the rate so much as the profitability of the project. So we're kind of like your partners. We have the same interest you do. So when we piece all that together, when developers come to us, we get a development appraisal. And you'd be surprised at how poor those development appraisals are. And we have to do all that work on behalf of you. So let's just look at the project overview. What should be in a project overview? Well, these things, I would assume. Project overview, the town, the location map, the economic drivers in a deal, the local demographics. You should talk about planning. We need site photos, drawings, and again, risks and mitigants. I mean, this is just fundamental stuff. We also look at affordability, which has been talked about a lot. We look at the median household income. We look at the loan multiple, what it should be. We look at what the help to buy schemes, can provide in terms of the capital. We look at the deposit. We kind of pick a number. We add it all up, and we come to a number, and we compare it to our unit stack to see exactly whether or not that fits the affordability scale. And then we plot it. And we plot it by square footage, and we plot it by unit. And we see where we fall within that range to make sure that we're not building stuff that isn't right. Because so much, I mean, there isn't a lack of supply in this market. There's plenty of supply. It's just supply at the wrong price. You know, so many people build stuff that just inappropriately priced. So we just want to make sure that we're building for the market. So when you put a deal memo together, you've got to pull all this stuff together as a borrower. As a borrower. You know, very few lenders have the capability of doing this. And if you think peer-to-peer is going to do this on the back end, you're kidding. And you can see what's happened to the peer-to-peer sector. You can see what's happened to the residential development funding sector. Look at what's happened to Lendy. And there's going to be another couple of shoes dropping in the next few weeks, which you'll hear about. Big household names. And the reason is because they drove capital out the door at any cost. Low volume, low margin business based on volume and fees. And they didn't do the proper underwriting because they don't have the market knowledge or the capability or the infrastructure to do that. So, thank you. So, lending to developers is a complex business. It's something that requires a certain skill set and toolbox, if you will, in order to be able to do. Which is why, besides the capital requirements, which is why most banks don't do it, because most banks are tick box lenders, right? Development finance is not a tick box lending exercise. It's a bespoke exercise that requires a skill set. Finally, we add it all up, we put together a financial model, which is usually dozens of pages long, but this is just a summary of what we can see, what the returns are. Are we comfortable that the developer is getting enough profit on his efforts? You know, are we making enough money? You know, what kind of contingencies are there? And so we put it all together. As a funder, this is the underwriting checklist. Behind the scenes, behind the curtain that nobody ever really quite sort of understands what has to happen. These are all the things that we do on a deal. So when you go to a funder and they say, we're going to give you a term sheet in 48 hours, maybe they'll give you the term sheet, but that's just the beginning of a 6-month exercise, or should be the beginning of a quite lengthy exercise that's going to have to take place, because they're going to keep asking you for things. So you might as well have it all up front in a deal memo as best you can so that it doesn't take that long. Our process is about 8 weeks because we know what to ask. But this is what goes behind a credit paper. And it's a pretty long list. So we'll answer questions after, but that's just a brief overview for me in terms of what we're funding. I'm a developer, like I said, I'm an equity guy. I've been on your side of the fence. You know, I've been institutionalized. I've had to put these things together. So I quite understand the pain points that you guys are going through, but it's a very complex process. Thank you.
If you enjoyed this video, hit the like button. If you're not a subscriber, what are you waiting for? Subscribe, hit the bell icon. As soon as we upload, we'll let you know. And enjoy these. They're all dedicated to helping you be more successful in property. Happy investing.